Let's talk about using options to manage your risk in an investment portfolio. Before we do that, if you're thinking, what are options? All they are financial instruments, and they give traders the right, but not the obligation to buy or sell an underlying asset at a predetermined price and date. So they can be useful for managing your risk in a diversified investment portfolio. So if you're a seller of options, they can actually provide an income stream or be used to offset any losses in holdings, and you can actually profit from sideways market action. So what's risk management? All we're trying to do with risk management is reduce our potential losses by recognizing our potential risks in advance. And this can include just diversifying your portfolio, hedging strategies, and proper capital allocation. But we can also use options to help mitigate our risks in a portfolio regardless of the market climate that we're in. So at NetPicks, we actually like to use strategies that can help us produce profit in 5 different ways. So what is hedging? Hedging just refers to the practice of using financial instruments like options or futures contracts to reduce the risk of potential losses from fluctuations in asset price. And this can be done by buying or selling securities to offset potential losses from other positions in the portfolio. So for example, let's say you're long on a stock. Well, you might buy a put option on that stock as a hedge against potential losses from a decline in the stock price. You can also use it to manage the risk of individual investments or the overall risk in a portfolio. And it's actually pretty common practice among investors and financial institutions to help reduce the impact of market volatility and protect against potential losses. But again, it's always important to carefully consider the risks and the potential rewards of hedging before you do any of that. So one way that we can manage our risk is by implementing a covered call strategy. So this involves holding a long position in an underlying stock and then selling a call option on that stock. So that stock price rises above the strike price of the option. The trader, the investor, can sell the stock at the strike price, realizing a profit from both the stock and the option. But if that stock price falls, the investor could keep the stock, let the option expire worthless. That's going to limit the potential losses. So here's an example. Let's say you hold 100 shares of XYZ Corporation. It's currently trading at $50 a share. The investor believes that the stock price will eventually rise in the future, but they want to limit the potential loss if it falls. So the trader sells one call option on XYZ Corporation with a strike price of $52 and an expiration date in 3 months, for example. The trader will receive $2 a share in premium, or $200 a contract. That's just a made-up number. And as the seller of this call option, you do not want the price of the stock to gain a whole lot of traction to the upside. In a perfect world, the expiration date comes, the stock price is below the strike of $52, and you keep that premium received, which is $200, as income, because the buyer of that call option does not exercise the right to buy your stock, continue to hold it. Now, if that price does rise above $52, well, the contract could be exercised. And it's not a bad thing if you were thinking of selling the stock anyways at that price point. So in our example, the covered call option strategy is going to allow you to participate in the potential upside of the stock while also having some income if it drops. Another strategy is using options as protective puts. So this involves holding a long position in a stock, buying a put option on that stock. So if the stock price falls, you can exercise the put option, sell the stock at the strike price, limiting the potential loss. If the stock rises, the put option will expire worthless, but you will still profit from the stock. Because you bought the put, you actually pay premium. You don't receive it. So here's an example. You hold 100 shares of XYZ Corp. It's trading at $50 a share. Now you're concerned the stock price might fall, but you want to retain the potential for profit if it goes up. So the investor buys one put option on the corporation, on those stocks, with a strike price of $45 and an expiration date in 3 months. If the stock price falls below $45, you exercise the put option, sell the stock at $45 per share, realize a profit of $500 from the option, plus the difference between the stock price and the strike price. So if the stock price does not fall below $45, the option will expire worthless. The investor can keep the stock and retaining the potential for profit if the stock goes up. So in our example here, that protected put allows you to protect against potential losses if it falls, the stock, but you retain the potential for profit if it goes up. Now, options can also be used in combination with other securities to create even more complex strategies. For example, a bull call spread That involves buying a call option on a stock with a low strike price, selling a call option on the same stock with a higher strike price. That provides limited downside protection and potential for profit if the stock price rises. There's a whole bunch of strategies you get to use. So to wrap it up, we can use options for managing risk in a diversified investment portfolio. Maybe you're holding stocks for dividends, who knows? So when you implement strategies like a covered call and protected puts, you can protect your portfolio against potential losses, but still participate in the market upside movement. Hedging strategies, very popular with those that have substantial holdings, but it's also available to any retail trader. But as always, it's really important to consider the risks and the potential rewards of trading before implementing any strategies. And you do not need to have tens of thousands of dollars to start trading options. That's a myth. We have a one-day options trading strategy so you can make money whether the stock goes up, down, or even sideways. It's a free guide. It's called our 8-Minute Options Cookbook. Here's the link. You can also get it below in the description. Thanks for watching.